Hello and welcome to a discussion on the Citrin-Cooperman Manufacturing and Distribution Pulse Survey. The results of the survey noted that 92% of companies have had a physical presence in multiple states. In addition, 85% of the companies have had an increase in e-commerce sales over the last year. These two items have led to an increase in remote work from home. Eugene, what do you find the increase in remote work from home has had on both income taxes and sales taxes across the different states?
It can really be a significant impact, Marcy. What we start out with is the term nexus. And the term nexus really just means that connection to a state that triggers a state tax filing responsibility, whether it's related to corporate income taxes, collecting and remitting sales tax, say gross receipts taxes in certain states that have that regime. So that's the kind of the building block for the conversation. And when you have a remote employee in a state, that can create nexus and thereby a corporate income tax filing responsibility, sales tax, and so on, as I just mentioned. The idea, though, for manufacturers and distributors from a net income tax perspective that we really zoom in on is what's called Public Law 86272. And that's a federal rule that impacts state corporate net income taxes. And the rule says that a state cannot impose a net income tax if the company is merely soliciting sales of tangible goods. There's a lot to unpack there. There's a whole bunch of nuance when you think about, well, it only impacts net income taxes. What about sales tax? What about gross receipts taxes, franchise taxes? The public law does not cover that. So you have to keep in mind that it's really just about corporate net income taxes. Also, we have to think about the solicitation side. What does solicitation mean? Can you go a little bit further than that? And the public law does say that there can be ancillary activities or de minimis activities that are still protected. But we really do need to dive into the rules to make sure that a manufacturer or distributing company falls under the protection of Public Law 86272. So it's a wonderful protection for the industry, but we do still see that companies that are placing remote employees kind of peppered throughout the country, that dependent upon the role of that employee, there may be no public law protection. So there may be a corporate income tax filing responsibility in that state, or maybe an S corporation filing responsibility, a partnership return, which thereby flows the income up to the owner. So that public law may not be there if the remote employee is, say, an IT person or an accounts payable person who just happens to be working remotely from Nebraska or wherever. But again, that's a big part of the manufacturing and distributing industry, focusing in on that public law rule. There's also the idea of what we call economic nexus. And economic nexus simply means that filing responsibility is created through simply deriving income from customers within that state. So we also have to watch out for that, even without an employee in that state. So you think about, well, maybe a business had a filing responsibility even without placing that employee in the state. So they may be able to, without any real significant impact, place an employee in the state because they already had a filing responsibility because of economic nexus. However, Public Law 86272 trumps the economic nexus rule when it comes to a net income tax situation. So you have to think about all these different pieces. And we're just talking so far primarily about income tax and maybe gross receipts tax and so on. We haven't really touched on the other pieces yet.
Well, what would you say the impact would be on payroll tax as well?
Yeah, so on the payroll tax side, Marcy, we're seeing a big issue primarily in the Northeast when we think about companies that are based in New York, because New York has what's called the convenience of employer rule. And the convenience of employer rule, kind of putting it in a nutshell, simply means that if an employee is assigned to an office in New York and that employee happens to work remotely, then the employee's wages get sourced to New York for withholding purposes. So the company has to think about this convenience rule. And a few states have it. Most other states do not have such a broad net that New York casts with it. But if you are a New York-based manufacturer or distributor, and say you don't have offices anyplace else, just a New York office, and you decide to let employees work remotely, whether it's in the tri-state area of Connecticut and New Jersey, or across the country, you have to be mindful about the convenience of employer rule. And there's, again, a bunch of nuance with the convenience of employer rule. There's means of circumventing it through potentially setting up an office in another state where that employee can be assigned to, possibly not having that employee work in New York at all, because the convenience of employer rule in New York does not turn on until the employee actually works at least one day in New York State during the year. So the rule won't apply if that employee is like, okay, I'm just working from California, never going to set foot in New York. The rule does not apply. And then there's another term of art as a means of circumventing the convenience of employer rule. It's called a bona fide employer office. In the bona fide employer office, there's a memorandum issued by the New York State Department of Tax that goes through this litany of things, criteria that has to be met to fit into that definition of the bona fide employer office. But if you can jump over that relatively high hurdle, then the convenience rule should not apply. So manufacturers and distributors who have remote employees, they really need to think about these possible withholding rule issues, not just for New York-based companies, but as again, if you're a Massachusetts company and you have employees working in New Hampshire, there's issues on convenience rule there. Certainly during the COVID period, there was lots of contentious matters related to that. There's also sales tax to consider when we think about remote employees and how that impacts the manufacturing and distributing industry. What we think about on the sales tax side is both economic nexus and physical presence. So here in our survey results, where we see many instances of companies having presence in multiple states and also having an e-commerce function, we really do have to think about what the sales tax nexus and potential collection responsibilities are. There was a court case that came out from the US Supreme Court in 2018. It got a lot of press, called South Dakota versus Wayfair. And what that court case did was bless state laws that said that a physical presence wouldn't be required. Meaning that if a company derived a certain level of receipts from in-state customers, or there was a certain level of transactions with in-state customers, a company could have a sales tax collection responsibility merely based on that. So historically, it had been about physical presence, that the company had to have that potential remote employee in the state. So in this scenario where companies are expanding their geographic footprint, they may already have a sales tax nexus and collection requirement. So they could place an employee in that state knowing that, oh, I already have to collect Kentucky sales tax. So let's put an employee there because I know I already have that responsibility. So there may not be a real significant impact there, but each company has to understand its totality of facts and work through these processes to understand what happens. And we don't want to look back on it after multiple years and say, oh, you know what, we really did have a Kentucky sales tax collection responsibility. And now we have X dollars of exposure that we need to deal with. When instead, if you catch this issue on the front end, sales tax is really just a conduit situation where a business is collecting sales tax from the customer and pipelining it over to the state. So if you are in compliance on that, there's really, aside from the administrative costs, there's really no exposure for a company. So that's why we really love having conversations with our clients about this stuff on the front end.
And every state has their own set of rules, so it just makes it even more difficult.
Yeah, and it keeps me employed, Marcy. So I like all those different rules.
State and local tax continues to be a hot topic for M&D industries, as you can tell. Please stay tuned for more thoughts and information to come.